Teachers, please, you are requested to join with your name. Zoom user and the teacher who has joined with the some number is there. Please rejoin with your name. When you join now, that option comes to enter the name. There you can change your name and then you enter.
Lati ma'am, rename yourself.
She has done now. I think only Subhi ma'am is left. Others have joined. Minu ma'am, please check the attendance if you have that list now. I think only Subhi ma'am is left. Others have joined. Minu ma'am is also not there. Amma ma'am?
Okay, I will check. Wait a second. Harjot ma'am is also not there.
Ma'am, Harjot is not to join because she told that she is told to attend only business study session. She is taking only business.
Okay.
She'll be attending second.
Oh. Okay.
Mr. Dinesh also shared in the morning that he will not be attending account session. Amandam, shall I start now? I suppose all have joined by now, है ना?
All I have joined. You can start now.
Thank you, ma'am. So welcome back, teachers, to the second session in accountancy for today. In the previous session, we have discussed that which all items, which all topics have been added this year. So one of the topics is raising and writing of goodwill. Goodwill has always been a problematic topic for the students. मैम ऐसे क्यों करना है, ऐसे क्यों करना है, इसको क्यों राइट ऑफ करते हैं, इतने पे क्यों करना है, वैसे क्यों करना है. So again, one more technical topic has been added to the goodwill, that is raising and writing off. So we'll discuss this topic in detail in this session. If we have a look at the syllabus part, goodwill meaning is also added this time. This also I shared in the previous section. And if we come down in the notes, if we check, then goodwill is to be adjusted through current capital accounts or by raising and writing of goodwill. That means both the methods have to be followed as per AS 26. AS 26 is mentioned in admission also and at the time of retirement and death of a partner also. So in all these three chapters, change in PSR, admission of a partner, and retirement and death of a partner, this topic will be discussed. Earlier, we were using only one method where we used to pass the adjustment entry through capital accounts of the partners. But now both the methods have to be discussed with the students. We do not know whether there will be a choice in the question for the method or some special instruction will be there. That means specifically method will be mentioned that which particular method is to be used by students. So starting with the meaning of that goodwill already we have done. Otherwise, in simple words, if we want to say, goodwill is the market reputation of the business that it enjoys in the market, and because of that, it helps. Because of the goodwill in the market, the business is able to earn more and more profits. So different people have defined goodwill in their own words. One of these is given by Spicer and Pegler. Goodwill may be said to be that element arising from the reputation, connection, or other advantages possessed by a business which enables it to earn greater profits than the return normally to be expected on the capital represented by the net tangible assets employed in the business. This is the most comprehensive definition of goodwill given, because in this definition, all the points have been covered. The main points where children are confused or where all the basic points which are to be kept in mind all have been covered here. If we start from the beginning, it arises out of reputation. If the business is having more reputation in the business, definitely it will enjoy more goodwill. Connection with the other businesses. If that relation with the other businesses is better than similar firms, then my business will be having more goodwill in the market. Other advantages like supply of raw material, or if we have patents, or if we have a good location, we have done so many factors affecting goodwill. So all these factors possessed by a business lead to goodwill, and these factors enable the business to earn greater profits than the return normally. That means over and above the normal profits. If my profits, that means the profits earned by my business are more than the normal profits, which are expected to be earned by the similar firms. What do we call that in the accounting terms? We name it as super profit. Super profit is the difference between average profits and normal profits. So here it is, enables it to earn the super profit, means greater profit than the return normally to be expected. And this return is expected to be on the capital employed. That means net assets. We have discussed in the previous session also in detail what is capital employed, what are net assets. So whatever capital has been invested in the business and the return, what is expected on that capital. If my business is able to earn more profits than that, then I have a better position in the market and my business will be having goodwill in the market. I hope it is clear. AS 26, what does it say? AS 26, intangible assets, prescribes that purchased goodwill can be recognized in the books and self-generated goodwill cannot be recognized in the books. So what does this word recognize mean? The term recognize means to be shown in the balance sheet. What item we are to take in the balance sheet, that is, that particular item is recognized, mentioned in the balance sheet. It means self-generated goodwill should not exist in the balance sheet, that because no consideration has been paid to acquire the same. So at the time of reconstitution of partnership, that is, we can change in profit sharing ratio, admission of a partner, retirement or death of a partner. At that time of reconstitution, goodwill is not recognized in the books because no consideration in money or money's worth has been paid for it. And if goodwill is raised, it must be written off immediately. Immediately means within the same accounting year. When goodwill is debited and subsequently credited, it means goodwill is not accounted in the books because it is not carried in the balance sheet. In that case, AS 26 is not violated. The only thing to be kept in mind here is, if in case we are asked in the question to raise the goodwill, immediately it should be written off also. Otherwise, we'll violate the provisions given by AS 26, which says that self-generated goodwill should not be recognized, should not be mentioned, should not be taken into the balance sheet of the new business. Adjustment of goodwill at the time of reconstitution of partnership. There are two different methods. When goodwill account is raised, when goodwill account is not raised. When goodwill account is not raised, the other name for this method is when adjustment is made through the capital or current account of the partners, which we are doing till now. 2 years back also the second method was added, but there was an option of, to the students only, that whether they want to continue with this or not. But now this year specifically this method has been added. We'll discuss both the methods in detail. Before going further, one point is to be kept in mind, that under all the methods, all the cases, the treatment for existing goodwill, that will remain the same. It has to be written off in the old profit sharing ratio to the partners, because it is a purchase goodwill that has to be finished off now from the books. So entry to be passed for writing off the existing goodwill is all partners, capital or current account, as the case may be, depending upon the fixed or fluctuating capital. Capital account will be debited in case partners have fluctuating capitals. Current account will be debited in case they have fixed capitals. So their capital or current account will be debited in old profit sharing ratio to goodwill account. The full value of goodwill will be credited here. Whatever value is shown in the balance sheet, that full amount, existing amount of goodwill that will be shown, will be credited here, and it will be divided to the partners in their old profit sharing ratio. Old profit sharing ratio means before the agreement has changed. So we'll discuss all these methods under 3 different cases: change in profit sharing ratio, admission of a partner, and then retirement or death of a partner. So beginning with change in profit sharing ratio, let's have a look at the entries, journal entries. If capitals are fixed, this heading is mentioned wrong here. At the top, it should be fluctuating, and then at the end, second part is fixed capital. When the capitals are fixed, then the bottom entries are to be checked. If goodwill account is not opened, then entry will be passed: gaining partner, current account debited to sacrificing partners, current account. In this case, when adjustment entry is to be passed, we are to calculate the gain or sacrifice also made by the partners. So we'll multiply the gain or sacrifice with the full value of goodwill of the business, and then this entry will be passed. But if goodwill account is open, that means goodwill is raised and then written off. What do you mean by raising of goodwill? That means goodwill account is to be opened. Goodwill account will be opened by debiting it, being an asset. As we know that goodwill is an asset, so if we are to raise goodwill in the books, we are to debit the account. So goodwill will be debited with full value to the partner's current account in old ratio. Suppose there are two partners A and B, and their earlier ratio was 3:2, and goodwill's value is 50,000. So we'll pass the entry: goodwill account debited 50,000 to A's capital account 30,000 and to B's capital account 20,000. And then immediately we are to pass another entry for writing of the goodwill, that is partners current account in the new ratio. Suppose now they have joined, agreed to have equal ratio. So it will be 25,000, 25,000 to goodwill 50,000. If the capitals are fluctuating, same entries are to be passed. The only difference will be that instead of having current account, we'll use the capital account. If goodwill account is not opened, entry will be gaining partners capital account debited to sacrificing partners capital account. And if goodwill account is opened, then goodwill account first will be raised with full value in the old ratio by crediting to the partners capital account. And then immediately it is to be written off. Partners capital account will be debited in the new ratio to goodwill account. Let's have an example. Amit and Sumit shared profits and losses in the ratio 3:2. With effect from 1st April 2022, they decided to share profits equally. Goodwill of the firm is valued at rupees 1 lakh. So old ratio here is 3:2. New ratio is equal and value of goodwill of the firm is rupees 1 lakh. Past successive journal entries under both the methods. First is when goodwill account is not opened, and then second is when goodwill account is raised and then immediately written off. Now, if we look at the question, it is not mentioned whether capitals are fixed or fluctuating. So they will be assumed as fluctuating because we know that when specifically nothing is mentioned, then capitals are assumed to be fluctuating. That means in this question, we'll pass the journal entries through capital account only. So first method, that means adjustment entries to be passed. So for adjustment entry, we need to find out the gain or sacrifice made by the partners. So old ratio is 3:2, new ratio is 1:1. And if we find the sacrificing share of Amit, that comes out to be 1/10 and Sumit is gaining by 1/10. So journal entry is gaining partners capital account debited to sacrificing partners capital account. That means Sumit's capital account debited to Amit's capital account. And the amount will be calculated by multiplying their share with the value of goodwill. That is 1/10 of 1 lakh. That comes out to be 10,000. I hope it is clear. First method, when goodwill account is not opened, we are to pass the adjustment entry. That is gaining partners capital account debited to sacrificing partners capital account with the amount of compensation which they will interchange. And that compensation we are to calculate by multiplying the share of their sacrifice or gain with the full amount of goodwill. If we come to the second method, when goodwill account is opened, then what we are supposed to do is, first we are to raise the goodwill with full value in the old ratio from the partners. That means goodwill account will be debited with rupees 1 lakh to Amit's capital account to Sumit's capital account. Old profit sharing ratio is 3:2. So this 1 lakh will be raised as 60,000, 40,000 from the partners. Immediately it has to be written off in the new ratio. That means Amit's capital account and Sumit's capital account will be debited to goodwill account. And since the ratio is equal, new ratio is equal, so 1 lakh divided by 2, that comes out to be 50,000. So both partners will be debited by 50,000 each, and then goodwill account is credited with 1 lakh. Just have a look once again. In first method, we have taken out the gain or sacrifice. Sumit is debited with 10,000, Amit is credited with 10,000. In second method, we have passed two entries. The net effect under both the methods, whether we use the first method of adjustment entry or we use the second method where we have passed two entries, first goodwill is raised and then goodwill is written off, the net effect under both the methods will remain the same. If you check it carefully, gaining partner capital account is debited with the proportionate gain only. See here, Sumit is gaining with rupees 10,000. And here also if we check, in this first entry, Sumit is credited with 40,000 and debited with 50,000. That means net effect on his capital account is a debit of rupees 10,000. Similarly, Amit is credited with 60,000 in the first entry and debited with 50,000 in the second entry. So the net effect is that Amit has got a credit to his account by 10,000. Sumit has got a debit of 10,000. Amit has got a credit of 10,000. So this comes the net entry only. Students will definitely ask कि मैम जब net effect जाके same ही आना फिर हम ये वाला method क्यों करें? So we have to tell them that because this method is mentioned in the syllabus, we cannot go beyond the curriculum guidelines. So we have to do that. And otherwise, to check their answer that whether it is correct or not, they can calculate the gain or sacrifice made by them, and then they can check whether they have got the same net effect or not. I hope I am clear. Is this question clear?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yes.
Excuse me, ma'am.
Yes, sir.
In silent case, we can follow any method.
Yes, sir. When no instruction is given, it is up to us.
Okay, ma'am.
But there, student must give the note that which method he has used. And students definitely will be going, I suppose, with the first method because they want to pass only one entry.
Okay, ma'am. Fine. Thank you.
So moving further, coming to admission of a partner, this chapter is again a problem for the students, especially the slow learners. Those who say कि हम admission chapter नहीं होता, बाकी सारे हो जाते हैं. Why? Because there are so many cases of goodwill here, and they have to understand, and then only they'll be able to solve the questions based on admission of a partner. So different cases of goodwill at the time of admission of a partner are: first case, when the incoming partner pays premium for goodwill privately. Privately means out of the business only, amount is not brought in the office and it is paid privately. Outside the business only they exchange the amount. Compensation is paid by the new partner to the sacrificing partners. Second is when the incoming partner brings his share of goodwill in cash, then further we have two options. The amount which he has brought in as his premium for goodwill is retained in the business, or second option available with the partners is that they can withdraw that amount, whatever amount of compensation they will be getting in their respective capital accounts, that amount they can withdraw. Next, third is when the new partner brings in his share of goodwill in kind. Instead of bringing in cash, he can bring some asset also. So that is also acceptable. That is also a form of premium for goodwill only. Fourth case, when the incoming partner is unable to bring full amount of goodwill. Suppose his share comes out to be 10,000 and he is unable to bring rupees 10,000. He is able to bring only 6,000. So that is the fourth case when he brings only a part of his share of goodwill. And the fifth one is when the incoming partner is unable to bring in any amount of his share of goodwill. जब वो कुछ भी लेके नहीं आया, out of 10,000 he is not able to bring in any share of goodwill. But when he is unable to bring in his share of goodwill, the sacrificing partners definitely will be asking for the compensation because that is not their fault that the incoming partner is not able to bring in his share of goodwill. So we will discuss these methods in short only because we have the main topic raising and writing of goodwill only. If we talk about first method, when the incoming partner pays premium for goodwill privately, we are not to pass any journal entry because the amount has not been brought in the books of the business. The financial position of the business is not affected. So no journal entry will be passed in the first case. And normally we all, most of us rather go for Viva also towards the end of the session for the practicals to the other schools. And whenever this question is asked from the students that mention the cases of goodwill, they normally start from the second case. They do not consider only the first case because in that case they say मैम entry तो होती नहीं है तो ये case क्यों बनाना. But this is also a possibility with the business. So we need to guide our students that they should not miss this case. Journal entry is not to be passed in the first case. Second case, incoming partner, when he is bringing in his share of goodwill in cash. So cash or bank account, whatever is the case, will be debited to premium for goodwill account. We can write both the terms. Premium for goodwill is also fine, goodwill is also fine. So journal entry will be bank account debited to premium for goodwill account. And then further, second entry will be passed when this premium for goodwill will be distributed to the old partners in their sacrificing ratio. Suppose there are two partners A and B and now C is being admitted. Whatever premium C will be bringing, that will be distributed to the old partners, that is A and B, in their sacrificing ratio. And by chance, if only one partner is sacrificing, the other partner is not sacrificing, then full amount will be given to the sacrificing partner, single partner only. We have discussed all these cases earlier also in the previous sessions, previous workshops. So we'll not go in detail for these. B part for this, B method for this is when the premium is withdrawn by the sacrificing partners from the business. अब वो कहते हैं जब हमारे अकाउंट में पैसा आया ही है, so why not to use that? So they have the option to withdraw this amount also. So we need to pass one additional entry, that will be their capital or current accounts now will be debited to cash or bank account, whatever amount they withdraw. They can withdraw full amount also which they have got, or they can withdraw part amount also. So it depends upon their requirement that how much amount they withdraw from the business. Then third is the incoming partner brings his share of goodwill in kind. There is no problem with this method also. Instead of debiting cash or bank account, we'll debit the asset brought in by the new partner. That means if we suppose he brings in furniture, so first entry will change. That will be furniture account debited to premium for goodwill. Second entry will remain the same. That will be premium for goodwill to the sacrificing partners capital account in the sacrificing ratio. Two entries will be passed. In first entry, whatever asset they have brought in will be debited to premium for goodwill. And then in second entry, the amount, whatever compensation, the sacrificing share, whatever we have calculated, the premium will be divided in that ratio to the sacrificing partners. Now, in all these cases, case number 1, 2, and 3, the incoming partner has brought in the premium for goodwill, whether it is in cash or in kind. So there is no problem at all, and this premium will be distributed to the sacrificing partners in the sacrificing ratio. Coming to case number 4 and 5, if we look carefully, there the partner is unable to bring full amount of goodwill. Either he is not bringing anything at all, or he is bringing only a part of his share of goodwill. So in case 4 and 5, when the premium for goodwill is not brought in by the new partner, the goodwill account is raised, or we can say it is opened for the amount not brought in by the new partner. We are not to debit full amount here. We are to open the goodwill account only on the basis of the amount not brought in by the new partner. And then it is immediately to be written off. That is the same condition, because AS 26 provisions are to be followed. So if a goodwill account is to be opened, then it has to be written off immediately. I hope it is clear till now.
Yes, ma'am.
Yes, ma'am.
So again, I apologize for the mistake here. It is written wrong. First is fluctuating capital and then is fixed capital. Let's have a look at the entries. If goodwill account is not opened, we have to pass the adjustment entry. That means it will be gaining partners capital account debited to sacrificing partners capital account. Here, most probably in most of the cases, the old partners are the sacrificing partners unless and until that there is some change in their share also. One of the old partners also becomes a gaining partner, then that partner also will be debited along. Then in second case, when goodwill account is opened, goodwill account is debited to old partners capital account. Goodwill account will be raised with full value and this full value will be based on the amount not brought in by the new partner. It will be raised from old partners and then it will return off to the new partners capital account in the new ratio. Same way, if the capitals are fixed, these entries will be passed to the current accounts of the partners. If we have a look at this these entries again, I suppose just a second. Okay. If we talk about the previous three cases, the first three cases, then entry is cash account debited to premium for goodwill and premium for goodwill is credited to the partner's capital account in the sacrificing ratio. But in case number 4 and 5, when he is not able to bring in any goodwill, then we will not credit premium for goodwill. So in case number 4 and 5, whatever amount has not been brought in by the new partner, for that premium for goodwill cannot be credited and further debited in the second entry. So that is why the adjustment entry passes gaining partners capital account or current account as the case may be to the sacrificing partners capital or current account. You'll be clear with this example. Dear teachers, this meeting will be over soon. So if it gets over, you are requested to join back soon with the same ID. Let's have a look at the example. Amar and Bhanu are partners with the ratio 3:2 and Charu is admitted as partner. New ratio they decide as to be 3:1. Goodwill appeared in the books at rupees 20,000. This is existing goodwill. So the very first thing we have to do is we have to write off this existing goodwill. Further, goodwill as on date of admission was valued at rupees 1,80,000. Charu is unable to bring in her share of goodwill. You are to pass journal entries giving effect to the arrangement under both the methods. Both the methods means when goodwill account is not opened, that means we are to pass only the adjustment entry. And second, when goodwill account is opened, we are to pass two separate journal entries. First will be goodwill is to be raised in the old ratio from the old partners, and then second entry is to be written off in the new ratio to all the partners, including the new partner. But in both the cases, one common thing is that the existing goodwill has to be written off in the old ratio to the old partners by debiting their capital or current account as the case may be. If it is fixed capital, so current account will be debited. If it is fluctuating capital, then capital account will be debited. So in this first case, for passing adjustment entry, we need to have the sacrifice or gain made by the individual partners. So taking difference of old and new ratio, Amit is gaining with 3/30 share. Bhanu is gaining, Amit and Bhanu are sacrificing with 3/30 and 2/30 share. And Charu is gaining by 5 by 30 share. So when we are to pass the adjustment entry, we are to multiply these shares with rupees 1,80,000, that is the amount of goodwill. So in that case, entry passed will be Charu's capital account or current account will be debited. If it is fixed capital, current account will be debited. If it is fluctuating capital, then capital account will be debited. So Charu's capital or current account debited. Amount here will be 30,000. Then Amit's capital account 18,000 and Bhanu's capital account will be 12,000. But if we follow the other method, first entry will remain the same. That means goodwill account will be written off first, existing goodwill of 20,000. Then second entry will be goodwill will be raised by 180 in the old ratio, that is 3:2, and then goodwill will be written off in the new ratio, that is 3:1, to the capital or current account of the partners, as the case may be. Is it fine? Is the example clear? So this meeting is getting over. Teachers, you are requested to join again.